Alright, thank you, Miss De La Cruz. Once again, good day everyone. I'm Vanessa Bahas and now I will tackle the topic errors and irregularities in the transaction cycles of the business entity. In this discussion, we will find out what are the three basic business transaction cycles, learn about the methods that increases fraud on sales, and the overview of the irregularities in the transaction cycles of the business entity. And of course, we will going to recap about the difference of skimming, lapping, and kiting. And as well as to explain the errors in each business transaction cycles. And last but not the least is the synthesis regarding the errors and irregularities in the transaction cycles of the business entity. But before I proceed, I would like to ask you a questions. What are these basic errors in business transactions? How did these irregularities arise? And what are the key controls that are needed to provide in order to minimize these errors? Generally speaking, management should establish controls to ensure that these transactions are appropriately handled and recorded. However, if internal controls are not properly implemented or overridden, fraud and errors may occur. So basically, without proper implementation of the key controls by the management, then fraud and errors may occur. Thus, the management must have an optimal way to handle and control the business to avoid these errors and irregularities in a business transaction. Now, here are the three basic business transaction cycles. The first one is sales and collection cycle. Second, acquisitions and payments, or also known as expenditure cycle. And the third one is payroll and personnel cycle. Now let's talk about sales and collection cycle. What are sales and collection cycle? Well, sales and collection cycle pertains to the recording of sales and cash collections of the sale. Basically, different entities may have different sources of revenue. This will depend on the factors such as the nature of the business. Actually, we have three nature of business: the manufacturing, merchandising, and the service. When we say manufacturing, it is the process of buying raw materials and creating these raw materials into finished goods, then selling these finished goods into the public. While when we say merchandising, it is a buying and selling of the goods. In a service form, you will provide a service in exchange of a cash. For trading concerns, the classes of transactions in the sales and collection cycle involve the following. The first one is sales. It could be in cash or on credit. Second one is sales adjustments. These sales adjustments includes discounts. When we say discount, it is a deduction on the usual cost of the product. Typically, these discounts are given to the buyer if they have an advance payment or prompt payment to the seller. While when we say returns and allowances, it is done by the buyer if the purchased goods or products has a defect or a damage. In the sales adjustments, it also includes the uncollectible accounts provision and the write-offs. And the third class would be cash receipts. When we say cash receipts, these are collections on accounts and cash sales. So the following are typical accounts affected by the sales and collection cycle. The first one is sales. Second is cash receipts. The third one is sales return and allowances. The fourth one is write-off uncollectible accounts. And the fifth one is estimate of bad debts expense. So what I did here is that I provide sample transactions in order for us to recall and remember how the entries go. For example, you made a sale to your customer in the form of cash or credit. Then we will debit accounts receivable or cash and credit sales. If our customer pay us the money, he will debit the cash and credit accounts receivable. However, if the customer doesn't want the products or the goods that he had been purchased, he has the option to return it. So we will debit sales returns and allowances and credit accounts receivable. If we have a write-off account, we will debit allowance for doubtful accounts or AFDA and credit accounts receivable, assuming that we are following allowance method. And at the end of the period, we will estimate the bad debts. So we will debit bad debt expense and credit accounts receivable. Again, here are the typical transactions or entries that we will find in the sales transaction cycle. This is another picture which accounts are involved and how they are affected. When we make a sale, we will debit cash in bank. As you can see, the arrow is pointing to the right, and we will credit cash sales. On the other hand, when we make a sale on account, of course, we will credit sales on account or sales, and we will debit accounts receivable. When we have a write-off, we will credit accounts receivable and debit allowance for doubtful accounts. However, when we have an estimate of bad debts, we will credit allowance for doubtful accounts and debit bad debt expense. However, when we have sales returns and allowances, we will debit sales returns and allowances and credit accounts receivable. On the other hand, when our customers pays us the money, we will debit cash in bank, also the discount, and credit accounts receivable. So now let's move on to the next slide. Here are the 8 business functions within sales and collection cycle. It starts by processing orders or process customer orders. Indeed, customers might send email or call through telephone or phone by sending their purchase orders. Once that it happens, we will send or create a sales order, and the sample of sales order is shown on the right side of the slide. In here, you can see the quantity of the goods being purchased, items, the description, unit price, discount, and line total. Once the sales order is created, it would be sent to the shipping or the billing and accounting department. In some companies, billing and accounting department are the same, while on the others, they are separated. Again, we will send the document, which is the sales order, to those departments for us to record the sales and as well as to know that there is a sales in process. The second one is granting credit. So what is granting credit? Actually, this is the process of checking if the buyer has the ability to pay his or her obligation. And the following questions may arise. Are we supposed to offer the customer these products on credit? Or is this an approved customer or not? Actually, selling in credit is easy, but collecting the money is what really matters. The third step is shipping goods. This is when the customer or the company, I should say, gives up the asset. And in shipping of goods, we will send the shipping document to the accounting as well as to the customer. After shipping the goods, we will bill the customers. Or the fourth step is billing or accounting department. And billing is the creation of sales invoice. Billing of the accounting role is very important because there is a need to match the shipping documents to the orders and invoice by checking the price, the quantity, and discounts, and so on and so forth. Actually, to ensure the completeness, all shipment made must be billed. While to maintain the accuracy, each customer must be billed with proper amount. The fifth step is processing and recording cash receipts. Actually, processing and recording is done when we are collecting the billed amount from the customers. Next would be the sixth step, wherein the process and recording of sales returns and allowances. This is done when the customer returns the product from the company and the company prepares the receiving report, and as we know, this sales returns and allowances reduces the sales. So now let's move on to the seventh step, which is writing off of uncollectible accounts receivable. Actually, write-off is based on the company's guidelines. Last part is providing for bad debts. Companies cannot expect to collect 100% of their sales so that at the end of each month or at the end of every quarter, they estimate bad debts expense. So again, these are the 8 steps of business functions within sales and collection cycles. Moving forward, here is the summary of the classes of transactions, accounts, business functions, and related documents and records for the sales and collection cycles. So we have 5 classes, which include sales cash receipts, sales returns and allowances, write-off and uncollectible accounts, bad debts expense. For accounting of the sales, we must debit sales and credit accounts receivable. For cash receipts, we will debit cash in bank and credit accounts receivable. And for sales returns and allowances, we will debit sales returns and allowances and credit accounts receivable. For write-off, accounts receivable and credit allowance for uncollectible accounts. And for bad debts expense and credit allowance for uncollectible accounts. So the following business functions affected in sales are processing customer orders, granting credit, shipping goods, billing customer, and recording sales. While on cash receipts, we have processing and recording cash receipts. For sales returns and allowances, processing and recording sales returns and allowances. And the fourth one is write-off and uncollectible accounts receivable. And for bad debts, we are providing the bad debts. And here are the documents and records. For sale, we have customer order, sales order, shipping documents, sales invoice, sales transaction file, accounts receivable master file, accounts receivable trial balance, and monthly statement. For cash receipts, we have remittance advice, revealing of cash receipts transaction file, and cash receipts journal of listing. For sales returns and allowances, we have credit memo, sales returns and allowances, and while for write-off, we have uncollectible account authorization form, general journal, and for bad debts, we have the record at the general journal. Now we will talk about the fraud and errors in the sales and collection cycle. Errors in recording sales and collection transactions includes number 1 is mechanical errors. So when we say mechanical errors, it includes using wrong piece or wrong quantity, or even recording sales in the wrong period or cut-off errors. So example nito, kunwari ikaw yung isang bookkeeper sa isang company, and according to the purchase orders of the customers, you are going to sell 7 pieces of laptops. While on the sales order that you have recorded 8 pieces of laptops, wherein hindi siya nag-match dun sa purchase order ng buyer dun sa sales order na i-produce or na-record mo. So that would be an example of wrong piece or wrong quantity. On the other hand, when we say recording sales in the wrong period, for example, you are recording transactions for the current year, but accidentally or unintentionally, you have included those transactions from the past 15 years, which is not accepted. Kasi hindi pwedeng pagsamahin ang transactions within this year at yung mga transactions on the past 15 years. Hindi siya pwedeng i-record at the same time. Dahil yung mga transactions that occurred over the 15 years was already recorded. And then, pag ni-record mo siya ulit within this year, so magkakaroon na tayo ulit ng mechanical error. Again, another example is bookkeeper's failure to understand proper accounting for transaction. So, example nito, you are offering a sale or recording sale from a customer, and you debit the sales and credit accounts receivable or cash. And that is not accepted because in recording the sale, you will debit accounts receivable or cash, and you will credit the sale. Actually, internal controls are designed to prevent or detect many of these kinds of errors. Now, let's move on. Fraud in sales and collections. When we say fraud in sales, it generally relates to fraudulent financial reporting. While when we say fraud in cash collections, it relates to misappropriation of assets, typically accomplished by clerks or management level employees. So let's dig deeper on these frauds, or particularly frauds in sales. So, fraudulent financial reporting typically results in overstated sales or understated sales returns and allowances. Thus, manager under pressure to achieve high profits may inflate sales to meet target profits established by senior managers, or even to keep their jobs. So the next are the examples, or the following are the methods can be used in increasing sales fraudulently. So the number 1 example is regarding fictitious sales. So in recording fictitious sales, it includes creating fictitious shipping documents and sales invoice, like what I have exampled earlier. And the second one is recording valid transactions twice. So instead of recording the transaction once, you have repeated it twice, and that is invalid. And the third one is recording in the current period sales that occurred in the succeeding period. So, yun nga, improper yung cut-off, kaya nagre-record, i-record mo yung mga past transactions within the current year, or yung mga future transactions ay nai-record mo within this year. And then, the fourth one is recording operating leases as sales. So, hindi mo pwedeng i-record as sales ang leases. Ganon din sa number 5, which is recording deposits as sales. Yung mga deposit, separate siya sa sales. And the sixth one is recording as consignment as sales. So, magkaiba ang consignment sa sales. So, hindi siya dapat i-record as sales. The seventh one is recording sales when the chance of a return is likely. Ganun din, kapag return siya, hindi mo siya pwedeng i-record as sales. The following revenue recognition practices that are not in accordance with PFRS. So, may time kasi na nagre-record ang isang bookkeeper kahit na hindi nila pina-follow yung PFRS, which is considered as fraudulent financial reporting. And then, the last one is recognizing revenue that should be deferred. So, kung deferred na yan, dapat hindi mo siya nire-recognize as revenue. Once na na-recognize mo na revenue ang deferred account or transaction, it could be resulted as fraudulent financial reporting. So, the next one is fraud in sales. Under of it would be misappropriation of assets, withholding cash receipts. So, the following are included in fraud in sales, which are number 1, skimming, lapping, and kiting. Actually, these terms are familiar to us dahil na-discuss na to when we are in first year. Actually, if I was not mistaken, during our Par 0 subject under Mr. Payabyab. So, let's move on to the first misappropriation of asset, withholding cash receipts. So, the number 1 is skimming. When we say skimming, it is an act of withholding cash receipts without recording them. So, actually, skimming is one of the most common occupational frauds because it was done by removing the cash from the victim entity prior to its entry in an accounting system. Example of it would be when a cashier in a retail store does not ring up a transaction and takes the cash. In that situation, the cashier did not record the transaction, but he takes the cash that he had been received. And the next example was when an employee who has access to cash receipts and maintain account receivable records can record a sale of an amount lower than the invoice amount. In here, the employee received an invoice with, for example, the amount is 150 pesos, but he recorded 140 pesos. And the customer pays, the employee takes the difference between the invoice and the amount recorded as receivable. So in that, the 10 pesos is the difference of the money paid and the recorded receivable. And in that case, the employee might stole that 10 pesos, which is the difference between the invoice and the recorded receivable. Actually, employees who steals money from the company steals the sales or receivables before they are recorded in the company. Actually, it is known as off-books frauds, meaning money is stolen before recorded. Those people who includes in the skimming are those who are the access with the customers. Example of them are sales people and tellers because they have a direct contact to the customers and obviously the most likely candidates for skimming. Detection of unrecorded cash receipts is difficult. However, unexplained changes in the gross profit percentage or sales volume may indicate that cash receipts have been withheld. So another form of fraud is lapping. When we say lapping, it is used to conceal the fact that the cash had been obstructed. So this means that the shortage is one customer's account is covered with subsequent payment made by another customer. For example, in your company, customer A owes 8,000 pesos and customer B owes 10,000 pesos. And during this day, you received the payment from customer A, which is equal to 8,000 pesos. But one of your employee have stolen the amount or the full amount of 8,000 pesos. On the following day, customer A received a notice coming from your company saying that, hey, customer A, you are not yet fully paid with the amount of 8,000 pesos. But since the employee is aware of the action that he had done, then he will do something to solve his problem. And that solution for him is called lapping, because since the company receives 10,000 pesos from customer B, he will use this 10,000 pesos to cover up the amount of 8,000 pesos for customer A, and that would be resulted the balance of customer A is equal to 0 and the amount to be recorded in customer B is 2,000 pesos, and the action that had done by the employee is called lapping. So in here, the example is an employee who has an access to cash receipts and maintains accounts receivable can engage in lapping. Actually, routine testing of details of collection compared with validated bank slips should uncover this fraud. So, by means of checking the deposit slips and the bank collections, you can now avoid lapping. Again, when we say lapping, it is another type of skimming, but the money had been stolen from one account and uses another account or different account to cover it up. Now let's move on to the third type of frauds in sales and collection. So it is called kiting. When we say kiting, it is another technique used to cover cash shortage or inflate cash balance. Or it is typically the action that involves counting the cash twice by using the float in banking system. When we say float, it is the gap between the time the check is deposited or added to an account and the time the check clears or is deducted from the account it was written on. For example, a bank owner has a money from Bank A which is equal to $1,000 and from another bank which is Bank B, it has a zero balance. But by means of kiting, this bank owner deposited $8,000 from Bank A to Bank B. And now, the cash balances of each bank is equal to $1,000 and $8,000. That means floating of funds between bank accounts just to inflate the cash balance is known as kiting, and the action that had done by the bank owner is known as kiting. Analyzing and verifying cash transfers during the days surrounding year-end should reveal this type of fraud. Moving forward, let's talk about the assertions, key control, and substantive test of transactions. So the following key control activities for sales includes adequate separation of duties, proper authorization, adequate documents and records, pre-numbered documents, monthly statements, and lastly, internal verification process. Now let's move on to the first key control activities for sales, which is adequate separation of duties. Well, it helps to prevent misstatement due to errors and fraud. The first one is the sales and cash receipts separate. Why? Because the personnel who is in charge in the sale should not be the one who receives the cash receipts. It means to say that if you are in the sales function, you should not receive the cash because you can process the sales and you can receive the cash. In that case, you can do or there's a possibility that you will do the skimming, which was previously discussed. And in that case, for example, the person who recorded transaction should be an independent party. Thus, it is separated from the one who inputs the data and the one who verifies the data. In this example, an employee recorded an accounts receivable to the subledger from sales and input and cash receipts. In that example, we could notice that the one who verifies and input the data is the same employee. So he might be saying that everything is good, everything is fine, I already checked it. And that would be the case or result of his or her action if the one who inputs the data is the same from the one who is verifying the data. The next one is proper authorization. So the auditor is concerned about authorization at 3 points. So proper authorization is very important to avoid fictitious sales and unworthy customers. The first point is to credit must be properly authorized before a sale takes place. So like what I have said earlier, there must be a proper authorization of the sales before taking place. And the second one is goods should be shipped only after proper authorization. So you cannot ship the goods properly if there is no authorization. The third one, and prices including basic terms, freight, and discount must be authorized. It is the way to avoid giving overpriced to the customer or giving lesser discounts to the buyer. Now let's move on to the third key control activities for sales, which is adequate documents and records. In recording documents and records, it can be done by the use of paper or electronic. Actually, adequate documents and records is the preparation of multi-copy pre-numbered sales invoice or the time a customer order is received, credit authorized shipment, record the number of units shipped, and bill customers. Actually, by means of pre-numbered multi-copy, you can produce a copy of sales invoice for the accounting department and the shipping department or the billing department, and a copy to the customers and as well as to your own. The fourth, pre-numbered documents help prevent both the failure of bill and duplicate billings and recordings. So in here, you cannot issue more than one sales invoice if the pre-numbered documents in that particular transaction is only one. Now let's move on to the fifth one, which is monthly statements. This is a useful control because it encourages customers to respond if their balance is incorrect. Prepare multi-copy pre-numbered sales invoice at the time a customer order is received, credit, and other shipment record the number of units shipped and bill the customers. In here, monthly statement is done to control those fictitious sales of transactions. And the sixth one is the internal verification process. Can be a manual or computerized. Actually, computer programs or independent personnel should check the processing and recording of sales transaction for cash of 6 transaction related audit objects. So those are the key control activities for sale. And now let's move on to the substantive test of transactions for sales. Management's assertion for the sale of transactions includes the following: occurrence, completeness, accuracy, classification, and cutoff. So let's start with occurrence. Recorded sales occurred. So in recording the sales, there are 3 types of possible misstatements. So these misstatements are intentional overstatement of accounts receivable and sales, while those who are recorded unintentionally, these are easy to find. Now let's focus with those intentional overstatement of accounts receivable and sales. The first one is sales includes in the journals for which in shipment was made, or this could be an error or a fraud. You recorded the sales, but unfortunately, there is no shipping document. Thus, in order to solve this problem, you need to do the vouching. So what is vouching? It means to say that you need to go back to the sales journal and go back to the source data. By means of comparing the sales journal and the source data, you can now solve the problem regarding the recording of sales which do not include as shipment. And the second one is recording sales more than once. So you need to look back for the duplicate sales numbers in order for you to minimize those numbers of sales. and record it correctly. The third one is shipments made to non-existent customers and recorded as sales. So you record sales with non-existent customers. Internal control deficient. Person recording sales is authorizing shipment. Compare customer information and sales invoice to the master file. So by means of comparing the sales invoice to the master file, you can solve the problem regarding the non-existent customer. So the next one is completeness. Existing sales transactions are recorded. So in here, less likely to be tested because the risk of overstatement of sales is more likely than understatement. So to maintain completeness, you must ensure that all the transactions are properly recorded. In order for you to track which are the non-existent transactions that you have been recorded, or if there are omitted transactions, you need to do the direction of test. So direction of test fulfills different objectives. The first one is tracing. From the source document to the journal test for omitted transactions. And when we say vouching, from the journal back to the source document test for non-existent transactions. And now, I will discuss the difference of the two. Again, in direction of test, it includes completeness test tracing and completeness test vouching. In completeness test tracing, you will start from the source document, which are the customer order, to the shipping document, to duplicate sale invoice, then sales journal, general ledger, until you come up with accounts receivable master file. On the other hand, in completeness test tracing, you must start from the journal back to the source data. So we will start from the accounts receivable master file to the general ledger, sales journal, duplicate sale invoice, shipping document, up until to the customer order. So the process of comparing the transaction must be followed like this. Moving forward, when we say accuracy, number one requirement, sales are accurately recorded. So it is the auditor concerns to record the sales accurately. The first one is shipping the amount of goods ordered. So we must make sure that the quantity is exact from the orders. And the second one is accurately billing for the amount of goods shipped. So it pertains to the price of the goods. And the third one is accurately recording the amount billed in the accounting record. So once you have issued the correct amount or the correct quantity, you should also record the correct price and record the billed amount in the book of records. And the second one, sales transactions are correctly included in the master file and correctly summarized. So the sales must be correctly totaled and posted to the general ledger if the financial statements are to be correct. And the second one is generalized audit software allows efficient testing of the accuracy of electronic journals and records. At present, most companies are using softwares in order to automatically or electronically record the transactions. And as we have noticed, and those electronic softwares helps the company to reduce the risk of recording those transactions incorrectly. Now let's move on to classification. Recorded sales are correctly classified. So, by means of correct classification, it could be a less of a problem in sales. Transactions are charged to the correct ledger account. For example, with the cash and the credit sales company, personnel should debit an accounts receivable for cash sale or credit sales for collection of receivables, just like what we have discussed earlier. The third point is should also not classify sales of operating assets such as buildings as sales. So those operating assets should be separated from the sales. And the fourth point is that for those companies with more than one sales classification, such as companies issuing segmented earnings statements, proper classification is essential. Now, let's talk about the last substantive test of transaction for sales, which is cutoff. Sales are recorded on the correct dates or in proper period. Indeed, sales should be billed and recorded as soon as after shipment. So after shipment, the bookkeeper must record those transactions that have been occurred. And now, the timely recorded transactions are also less likely to contain misstatements since you have already recorded those transactions and you don't need to remember those past transactions that you have been already recorded. Indeed, it would be easier for you to validate those transactions. And the third point is that compare the date on the selected bills or shipping documents with the date on the related duplicate sales invoice, the sales journal, and the receivable master file. So, by means of comparing the dates on the duplicate invoice that you have issued and to the sales journal and sales receivable, you will come up with correct recording of the dates. Well, I guess that would be all for my report. I hope that you have learned a lot from me. And now, may I call on the next reporter? Mr. Gyang, it's your turn.